Every tax season, millions of Americans sit down with their receipts, their donation records, and their best intentions, only to realize the government already handed them a better deal before they even started. The standard deduction quietly became one of the biggest tax shifts of the last generation, and most people still haven't caught up to what it actually means for their charitable giving. Back in 2017, the Tax Cuts and Jobs Act nearly doubled the standard deduction overnight. And just like that, the math changed for roughly 90% of American households. We went from a country where itemizing was almost a rite of passage to one where the IRS essentially preloaded a discount for you, no receipts required. Think of it like this. Itemizing used to be the premium gym membership that serious savers used to maximize every dollar. But now the standard deduction is a free gym that's honestly pretty good for most people. The problem is, a lot of us are still paying for both memberships without realizing it. For 2024, a single filer gets a standard deduction of $14,600. A married couple filing jointly gets $29,200, and you need to stack donations, mortgage interest, and other deductions well above those thresholds just to make itemizing worth your time. That's not a small hill, that's a mountain most households simply won't climb. Here's the quiet irony nobody talks about at dinner parties. Charitable giving actually declined among middle-income households after 2017, not because people became less generous, but because the tax incentive quietly evaporated for most of them. The deduction didn't disappear, it just got buried under a standard deduction so large that your church donation became financially invisible. Now, wealthy donors are a completely different story, and this is where the plot thickens in a very human way. If you're donating 6 figures annually, running a donor-advised fund, or bundling multiple years of gifts into a single tax year, itemizing is absolutely still your move. The math works loudly and clearly in your favor. But here's where behavioral economics crashes the party. Studies consistently show that people give less when they don't feel the immediate financial reward of a deduction. We told ourselves for decades that the tax break wasn't the reason we gave, and then the second it went away, for most filers, giving patterns shifted, which is either deeply revealing or deeply human, depending on your mood. One strategy that's genuinely underused is something called bunching, where you concentrate 2 or 3 years of planned charitable giving into a single tax year to blow past the standard deduction threshold. It's not sexy, it's not viral, but it works. And a donor-advised fund makes it elegantly simple to execute without changing the actual pace of your giving. Let's also address the misconception that if you can't itemize, your donation doesn't count for tax purposes anymore. That's not entirely true. During the pandemic years, Congress allowed a small above-the-line deduction for cash donations, even for standard deduction filers. And while that provision has expired, it's a reminder that the tax code is always evolving and worth watching. There's also a wildly underappreciated strategy for anyone over 70 and a half, the Qualified Charitable Distribution, or QCD, which lets you donate directly from your IRA to charity up to $100,000 per year, and it counts toward your required minimum distribution without the money ever touching your taxable income. That's not a loophole. That's the tax code actually working as intended, and almost nobody uses it. The broader lesson history keeps teaching us is that tax strategy isn't about finding the one perfect move. It's about understanding the system you're operating inside of and adjusting your behavior accordingly. The people who got hurt after 2017 weren't the ones who lost the deduction. They were the ones who never updated their assumptions. Here's the process that actually protects you. Run the numbers every single year. Don't assume last year's strategy still applies. And if your deductible expenses are within striking distance of the standard deduction threshold, talk to a CPA before December, not April. Discipline and timing matter more than conviction. And in tax planning, the patient, methodical filer almost always beats the reactive one. The philosophical truth underneath all of this is that giving was never supposed to be a tax strategy, and the people who give for the right reasons tend to find smart ways to make the math work, regardless of what Congress does next. Sizing your generosity around your actual financial plan, not just your emotions in December, is where discipline and good values genuinely overlap. Whether the standard deduction stays where it is, rises again, or gets restructured entirely when key provisions sunset after 2025, the rational move is to stay informed stay flexible, and never let tax tail wag the charitable dog. We can't control the tax code, but we can absolutely control our preparation for whatever it becomes. And if any of this has you thinking bigger about building wealth, making smart investments, or finally tackling that home project that could add real value, check out our links in the description below, where we can help you get started, whether in real estate investing, home contracting work, or finding the right lenders.